Welcome to Stocks in Translation, where we translate the world of finance into real-world impact. I'm Jared Blickery, joined by the voice of the people, Sydney Freed. And thanks to you all out there for turning on the sound. And before we jump into the conversation, please be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, or wherever you get your podcast. Today, I'm very excited to announce we are welcoming Abby Yoder. She is a U.S. equity strategist at J.P. Morgan Private Bank. And today we're going to be talking about all the opportunities in large cap stocks, particularly healthcare, along with the industrials, with a healthy dose of AI. And our word of the day is infrastructure, what it really means for investors. This episode brought to you by the number 300. That is a dollar amount of reshoring agreements since 2021. And that's right, we're going to bring it all home here. Abby, we are at record highs. And I was doing the math. Actually, Brian Dietrich was doing the math. He says 22% of the days this year, that's basically 1 in 5, have been record highs for the S&P 500. I didn't expect that at the beginning of the year. But how are you seeing the market right now?
Well, yeah, I mean, I don't think that most people would have guessed that we would have been at 41 new all-time highs this year. That's where we are today, right? Or as of yesterday, at least during the close. And I think that's what surprised investors this year. It really has been, I think, and given all the macro uncertainty, very surprising to see the market just continue to march up. And I think what we're debating as we think about maybe the year ahead, the next 9 months, like where, can we see upside? If we can, right?
Yeah.
Like that's the debate. Where can we see upside? And the when you think about it, like just simplistically from an index level, it's like, okay, are you going to see it from an earnings standpoint, or are you going to see it from a multiple standpoint? And I think what's surprised everyone over the past couple of years is really the multiple. Like earnings definitely have surprised, but the multiple has stayed elevated, right? We're close to 22 times right now, and we in our outlook had multiple compression in terms of our year ahead outlook.
Yeah, we're going to get into earnings versus multiples in a little bit. I do want to talk about our word of the day, which is infrastructure, and this is going to help us get into some of those opportunities we might find in the rest of the year to come. So let me just define it here. Infrastructure includes the basic physical systems like roads, power grids, and water supply that support economic activity and public services. So it's critical for societal development as well, and often requires large-scale investment. And I found that the term comes from French, the etymology, combining infra, below, with structure. During the 1940s, NATO popularized it to describe military installations. And then by the 1970s, it expanded to include civilian uses. And then nowadays, people talk about not just physical systems, but also social institutions and services like education, healthcare, and law enforcement. Everything that's basically essential for economic and social well-being. So what does infrastructure mean to you?
Well, wow, that was quite a lot.
Thank you.
In terms of investing, I mean, you have to think about who are the picks and shovels that go into that, right? And that's the industrial sector. And the industrial sector is very broad. It has a bunch of different end markets. But when we think about it, we think about not only the public spend that's coming from the government over the past couple of years with over $1 trillion in stimulus spend that's dedicated to infrastructure that in the U.S. is very old, whether that's roads, bridges, the grid, and then also from a private standpoint as well, when we think about this reshoring theme where we're trying to simplify supply chains and move away from reliance on countries like China in terms of our supply chain. So those two forces really help.
So how would you say is the best way to invest in infrastructure, either physical or something like societal, law enforcement, education? I don't actually even know how you invest
in
in
private
those things.
prisons.
Taxes?
I mean,
I guess.
maybe. I don't know if we want to go there.
Well,
but
I don't know. So let's go to physical.
Yes.
What are some of the ways someone who doesn't know that much about investing in infrastructure can start?
You mean in terms of the private part of it?
Yeah, or like stocks, ETFs, that kind of thing.
Well, so from an ETF standpoint, I mean, you could always get exposure through the industrials ETF. That's going to give you a little bit different exposure because you also are getting like aerospace and defense. That's another longer term theme that we do like. But that's really how we would talk about it in terms of with our clients getting access.
And I want to go back to a point you raised earlier, earnings versus multiples. Could you just kind of break that down for the viewers?
Yeah, so the way that you get to an index target, so a price for the S&P 500 is going to be based on what your earnings outlook is, so a dollar amount, and then what your multiple is, so what your PE multiple is going to be. So essentially, what price are you willing to play for those earnings? And
17 times, 35, whatever.
yeah, and historically, actually, the market is traded closer to something like 16 and a half times. And like I said, we've been in that above 20
We've
times
been
range.
elevated for a while.
And that's the thing. It's defying expectations. And I think that it speaks to the unique nature of this cycle as well.
Do you think it's mean reverting? Do you think we have to go back down, or is this the new normal? I don't. It's a bold question.
It's a very existential question, and I think that that's like we were just having this conversation because we were talking about mean reversion of PEs, but when you think about the changing composition of the market, right? Like tech is close to 40% of the market now. It was less than 10% in the early 2000s. It's a higher multiple sector. Then you can make the argument that, from a secular standpoint, multiples should be higher.
So we're talking about how stocks are at record highs. Some people are surprised to see the rally kind of holding on to that steam. What risks do you think could kind of stop that rally?
Well, I mean, look, we're heading into the last couple of weeks leading up to the election. Historically, what you do see leading up to that is a step function higher in volatility, so, bigger moves in the stock market. So that's one thing that we're looking at. And then also geopolitics, right? We've gotten some headlines that are very concerning in the Middle East, and there's a lot of wars that are going on. That's not something that we can really underwrite in terms of equity investors, but it's a risk out there that we think
It's just so interesting because right now I feel like everyone keeps saying like the next risk, the Fed rate cut, this and that, and then somehow the markets are still rallying. I think when consumer confidence came out, markets saw like a downturn for like 2 seconds and then it kind of went back up. I guess as someone who doesn't understand everything, I'm just confused how we are rallying or coming back so much every time we get a little bit of bad news. Is it all just priced in a little bit?
I mean, look, there's that argument, but what is really driving the markets right now, to your point, is that over the past couple of years, the Fed has been fighting inflation. It looks like they might have won that battle, right? Like they feel that way because for
the time being.
We have a 2% handle on inflation after it was 9% in 2022. So it feels like they can move away from focusing on that to focusing on the labor market, which has weakened at the margin, right? But still is fine. It's just weakened at the margin. So it looks like what they're doing in terms of their 50 basis points cut over last week was to get in front of that. And that's what's propelling this optimism at the moment is that, okay, they're cutting rates. It looks like they're going to front load that. Like maybe they'll go 50 again in November, and that should help sustain growth going forward.
I want to ask you about that 50 basis point cut. Just what do you think about it? It could have been 25 or 50. 50 seemed a little aggressive to some people, and it could be a little scary because if the Fed is going 50, 50, 50 instead of 25, 25, 25, what are they seeing that I'm missing? That's the question I'm asking myself.
And it's interesting because it didn't matter who you talked to. There were like 5 different camps in terms of like, would a 50 basis point cut be good?
Maybe
like it was very unclear. And it was even unclear post the decision, right? Like the market was up and then it traded kind of flat that day, but the next day
day we saw it.
Okay, we digested that, and I guess that was good, right?
I guess that was it.
It was record highs the next day.
Yeah, and I think that Powell balanced with the 50 basis point cut with being like relatively like down the line in terms of like his press conference, and I think that's why the market feels comfortable. Like, hey, you're not really seeing anything that's scaring you. You just did this because you have the power to do it because you have 550 basis points worth of cutting ability.
Right. Going back to some investing, you said you're liking aerospace and defense recently. What else? Why that? And what else are you liking?
Well, I mean, just think about the trends that are going on globally, right? Sadly, from a humanitarian standpoint, but just thinking about how many NATO members are now increasing their spend in terms of GDP. I think it went from 3 were abiding by the 2% of GDP in military spend in the early 2000s, and that's going to be closer to 18 by the end of the year. So just globally, you're seeing an uptick in spend. So that's a big part of the industrial sector. And then similarly, we also like tech, being a little bit more nuanced there, and then also healthcare Let's
talk about tech for a second, and specifically AI. What are we going to see with AI? New developments, the reframing of existing developments. What do you expect?
I mean, I think right now the market's asking what are the real use cases right now? And this is outside of tech, right? Because tech
like who's going to pay money in subscriptions?
Who's going to pay for it, and how are they going to use it, and is it actually going to be more productive? Like that is those are the main questions, because you have the hyperscalers saying that they're going to spend as much as they can right now because the risk of underinvesting is way bigger than overinvesting. But it's like, okay, we get that from your standpoint, and to a certain extent, those they're monetizing that already. But what is a financials company? How do they monetize that? How do they use that? And is it the best spend for them? Is it going to be productive? And so I think that's really the big question in markets at the moment.
And from an average person's perspective, I'm waiting to see what is it going to do for me on my device.
Yeah.
It's I get ChatGPT
right here. Yeah.
Right here. I understand kind of the bots, and that's great, and we've had bots for kind of a while, but what else am I getting out of it?
Well, and I think the next iteration is going to be, it starts thinking a little bit more like a human,
yes.
right?
Reasoning,
it's not just
chain of thought, all that
it's
good
not
stuff.
just giving you data that you ask for, which is what I really honestly I do use it every day.
Oh yeah,
even an internal model that we use, and I love it. I really think it's
I depend on it.
Oh, I love, it's made a huge difference. But I think in terms of the go forward, it's just proving that makes you more productive to a certain extent.
Have we seen the movie iRobot at this table? Or
I saw that
yes.
a long time ago.
Yeah, that is an
I
old
enjoyed
movie,
it.
no?
It is.
But it's based on
Will
the Isaac
Smith.
Asimov book.
Based on the book, are you at all scared about this is not a strategist question.
No,
I'm
go for it.
so ready to answer this.
Yeah.
Yes, I think about
Because
this.
at a Harvard conference, there was a regulatory panel, which was hilarious, and they started the panel, and they said how many, and this is professors, CEOs, not students. This is and they asked how many people in the room think that AI is going to cause our extinction. More than 50% of the people in the room raised their hand. But what I think was really interesting thereafter was there was a comment by one of the panelists who they said, one of the problems is we're projecting a lot of our fears and human
foibles and everything
on robots, right?
But
and so there's that.
these robots are being trained on our own foibles,
True.
so maybe they're just going to reflect them back.
They apparently don't have our emotion, right? So there's
Yeah.
a big.
Apparently.
Yeah.
But that's when they told you don't let your kids be rude to Siri or
Oh,
that
I
kind
always
of
say
stuff.
please and thank you,
Oh,
and
yeah.
good morning.
I think
Oh,
it's just
no,
good
but-
practice,
yeah.
good habits for a human.
I'm not denying that, but I'm saying they're whatever robot exists in there, they do hear those
Oh
things.
yeah. Oh yeah.
I'm scared.
Well, and there was the New York Times did this was really early on too, I think last year even, where they started talking to it and they were seeing how the conversation evolved, right? Because it starts to get to know you, and the chat did get a little bit emotional, and so there is this element where there is the possibility. So
All right, we got to take a quick pause. We're going to take a very short break. Coming up, we're going to be talking about reshoring manufacturing in the U.S., as well as a Who Wore It Better that stacks two approaches to medical care side by side. This episode brought to you by the number 300 billion, which is the number of dollars allocated to reshoring agreements since 2021. From chip manufacturing to critical infrastructure upgrades, the U.S. is shifting its supply chains back home after the disasters of the pandemic. The momentum has only increased following deployment of the CHIPS Act funds and other government incentives to boost domestic production. So, Abby, tell us the importance of reshoring and reinvestment domestically.
I mean, it's a huge theme, and it's real, right? It is actually happening, and I think everything that's going on geopolitically, like you mentioned, the supply chain shocks over COVID, that was kind of, it was already happening before COVID, and then COVID happened, and things got so complicated. And
we had a trade war already.
Yeah, and supply chains are just infinitely more complicated. We have this potential port strike that might happen on the East Coast. That is terribly disruptive. Apparently, for every one day that port could be closed, it would take 5 to 6 days to get those supply chains up and running again. And so
that's the thing is, we have these with the benefit of AI and all our technology, we can calculate, to the day when we're going to need this product. But then if it doesn't come, you need a backup. So these just-in-time supply chains might be a bit more fragile. Any thoughts on how we overcome that? It just seems almost intractable.
I think you're right. I think there's a rethink on those. There was very much a rethink on those just-in-time inventories in 2020, 2021. But then you saw over-inventoried in certain industries as a result of that. I think that having it like reshoring and all of our inventories closer to home will make companies feel a little bit more confident, because it's right there, they can do it. And if we're manufacturing things here, they feel like they have more of a pulse and there aren't so many stops on the way.
Maybe it's the confidence that matters.
Yeah. Well, I think so from a CEO confidence standpoint, 100%.
I want to get to some of the chip makers. I kind of have been learning over time that they don't all make their own chips, which is kind of shocking to hear. They just design them and they kind of ship them out to be made. How important is it to actually make the chips here in the U.S.?
Oh, very important, right? Like, think about how many things.
It's that confidence.
Well, that, and think about how many things semiconductors go into, right? Like, that's the other thing. And like going back to the AI race, we want to be first in line for that. And we are at the moment, right? And so we want to have control over, I think, from end to end, that production process. So I think it really does make a huge difference if it isn't in the United States.
I don't feel like your average person really understands the process of like what the chip is for, who makes it, where
so
it
many.
ends up.
Yeah,
they're different kinds. I mean, the very best ones are something like 3 nanometers now. It's the scale. So like a nanometer is a billionth of a meter. That's how small the distance is between 2 transistors, theoretically, maybe. Don't quote me on that. But you go up the scale and then, so to develop the newest ones takes an awful amount of ingenuity and new technology, but, Texas Instruments they create the ones that might go in your pocket calculator, or, some of the sensors. There's just, Qualcomm does mobile. I mean, there's just all kinds of different facets of semiconductors. It's such a broad base.
I wonder if we're going to be at the point where like I have a device and I could be like, this is the chip that's in that device. I know like other people can, the experts can.
Oh, the experts.
But if I'm like, what is my phone running on right now?
And how many things did they fit on that tiny little chip?
Whatever it is. I'm waiting for that.
All right. I do want to move on to our Who Wore It Better segment. Preventative medicine versus reactive care. Which approach is better at keeping healthcare costs down and improving patient outcomes? So on one side, we have preventative medicine, which focuses on stopping illnesses before they start, using the innovations like GLP-1 drugs to tackle conditions like diabetes early. And then on the other side, we have reactive care. And that steps in when disease strikes, offering life-saving treatments that target advanced illnesses. And so let's explore the benefits and limitations of each. And it kind of depends on whether you're large cap or small cap, biotech versus traditional, but kind of let's break it down. We want to know. So here's a question, sorry, because there is a question at the end. Which strategy is wearing the future value of healthcare to humans better?
Well, I mean, look, the goal of our healthcare system would be to be preventative in nature. We don't want people getting sick, but the way that it works now is that it's very much reactive, right? Like we get sick, so we go to the doctor and they treat us. In theory, what would be wonderful is every facet of the healthcare system in the United States would work together. That's hospitals, physicians, insurance companies, pharmaceutical companies work together to try to make it so that we're more preventative based. It would cost people less money. We would live longer. And so to your point on GLP-1s, the reason they're viewed as relatively preventative in nature is because they don't just make you lose weight. Right? Like they actually, and this is what like a lot of the trials are showing, is that they help reduce other illnesses. And they kind of get in front of like, even if like you're pre-diabetic and you go and take a GLP-1, like the rate of stopping you turning into a type 2 diabetic is north of 90%.
Yeah, it's pretty amazing.
Yeah.
Wait, I thought it would be a reactive medical care.
What, you thought it would be better?
GLP-1s. No. Just like I thought that's how we would
they are inherently, right?
Okay.
Like
because the condition is overweight? Okay.
Right.
Yes. So like they're used to treat obesity and diabetes. But what the trials are showing is that it can prevent, if someone, let's say so they'll take a patient population that's pre-diabetic and put them on these GLP-1s and it'll stop them from becoming diabetic, which has so many, like obesity and diabetes have so many comorbidities associated with them that like that in itself like could be preventative longer term.
Right. Backing up, so what, if I'm new to investing and I like first of all, tech is like all the rage, I think, especially to people who don't know that much about markets. Should you consider investing in healthcare, I guess is my first question.
Well, yeah. So I think look, healthcare has underperformed 7 of the last 8 years, despite being the only sector in the S&P 500 to have positive annual earnings growth aside over the past 21 years.
Interesting.
One time, and it was last year, and it was the COVID overhang. So, And the way that we think about it too is like when you think about investors and they're looking for growth areas, obviously tech is one of them, but healthcare is too, right? Like it's an innovative, typically like higher growth area. And so I think what you saw after the outperformance in 2022 was everyone for healthcare, like you saw them all take those funds out and put them in tech, which has been the right call, right?
I remember early 2023, it seemed like the GLP-1s were neck and neck with the AI trade for a while.
Yeah.
I want to touch on a misunderstanding that you were noting in your notes to us, that large cap pharma and biotech companies are the ones that are price gouging consumers. That is the misunderstanding?
Yeah.
Okay.
Yeah.
Who's price gouging?
So they're what called middlemen, and we heard this in congressional testimony yesterday. They're called PBMs, pharmacy benefit managers, and they sit between the pharma companies and insurance companies and retail pharmacies, so pharmacy dispensers. And they have a very opaque business model. It's very hard to understand how they're making money, but for the most part, they're working with the pharma companies to get rebates, basically, and then they retain that.
Yes.
And don't necessarily, what pharma would argue is that they're not passing on those price savings to consumers, ultimately.
Well, I remember in my youth, I didn't have health insurance. I mean, this was 20 years ago. And I would go to the doctor, I would get a prescription, and I would get some kind of a deal at the pharmacy. You know, it would be a rebate or whatever.
Yeah.
But the price changed, it seemed like, every time I would go into the pharmacy. And that made me think, well, the prices are just arbitrary then. Is that the case?
I mean, yes.
Okay.
And the problem also, I think what some companies are trying to solve is exactly that. There are some companies out there that will help you navigate that very tricky pharmacy. Because to your point, it can be different if you go to a different pharmacy, if you do it online. And so they're trying to help you access and navigate that. But yes, it is very much true that it seems that it's relatively random.
What's the risk or the potential for volatility in the healthcare sector that might make it something that you wouldn't suggest investing in?
Because there's not a lot of volatility.
No, so typically,
or none.
Yeah, no. So typically that's the way it's viewed. It's more defensive, right? So thinking about why do I want to, what sector can I own that has, to my point earlier, steady earning streams, right? And that's going to be your more defensive sectors like healthcare, like staples, like utilities. Those are typically what you want to own when you're really nervous about the economy, because you don't stop buying healthcare, right? You've seen,
it's true.
Healthcare
Still
spending
use
continues.
electricity in healthcare.
You continue to see healthcare spending as a percentage of GDP tick up, and so it's actually viewed as less volatile than the overall market.
We want to get a little personal.
Yes, we understand.
We were discussing a little off camera that you haven't always been a strategist. You were actually, you were at one point a baby.
Strategist at JP Morgan.
At one point you were a child, but you were actually an art history major. Tell us a little bit about your college years and studies.
Yeah, and it's funny, I went to a college that was primarily focused on medicine, and I didn't study that, obviously. And I just picked art history. My dad was an art history major. I love history, but I wanted to do it through a more visual medium, and it led me to that, and I absolutely loved it.
I love that. And your first job was a paralegal.
A paralegal.
How did you go from art history?
That was one of my first jobs too.
Really?
Yes, I was 18. I started working for a securities lawyer in Miami, and that kind of got my start into finance.
Yeah, I know. So I similarly, I thought I was going to go to law school. I thought the big dream was exactly. And then a year in, I was like, this sounds expensive. I might try something else. And that was kind of my path.
I love that. We have 30 seconds left. What is one final word you want to share with investors right now?
I mean, I think it's really easy to be nervous, and we can see that in markets, and it does feel like this is a nervous high in terms of the market level, but we're pretty constructive going forward. We think the economic backdrop looks good, the earnings backdrop looks good, and so we feel good about equities at the moment.
All right, we're going to have to leave it there. And make sure, though, all of you out there, to check out our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. That's all for now. Abby, thank you so much for stopping by. Sydney, as always, and thank you.